Welcome to Real Estate Conversations from Compass. I'm Mike Simonsen. I'm the chief economist for Compass, the largest real estate brokerage in the country by sales volume. My mission is to help everyone understand what's actually happening right now in the real estate market so they can make the best decisions when buying or selling a home. With Compass Intelligence, we publish the latest data every week. You can see that data and my video analysis on the Compass YouTube channel, and you can get on our Compass Intelligence mailing list. We put the data, video, and charts in your inbox every Monday. With the Real Estate Conversations podcast, I seek expertise and insights from the best leaders and thinkers in our industry. These conversations help me understand and hopefully help you understand the trends and dynamics driving the market today. So stick around for more real estate conversations. Today's conversation is with Eric Finnigan, the Vice President of Demographics at John Burns Real Estate Consulting. If you think about it, demographics is behind everything in the real estate market. How is the population changing? Where are people moving? What's happening with migration and immigration? I invited Eric on the show today to help me learn about the demographics driving the U.S. housing market today. This conversation was outstanding. I learned about how much pent-up demand there is for people who want to move but haven't moved for several years. Which markets are riskiest from a demographic perspective? We discussed the latest data on work from home and return to office policies. Eric teaches me about the actual impact of the latest immigration policies. What's actually happening may be different from what you might expect. We talk the age of home buyers and the affordability problem and so much more. This is a great talk, so stick around for Real Estate Conversations with Eric Finnigan and me, Mike Simonsen.
Eric, welcome to the show.
Thanks, Mike. Glad to be here. Excited to chat today.
Yeah, so we're going to talk demographics today. We're going to talk migration patterns and immigration. We're going to talk age and all of the things, boomers and millennials and tons of stuff to cover. And it's funny because the demographics in some ways drives everything in housing. But it sometimes doesn't get a lot of attention. And I love having the conversation with you. We can talk about what should we know and what's the data actually saying. So that's what's on the agenda for today. Let's start with what I think is the most dramatic pattern in the U.S. real estate market right now. It's the one that I start every talk I give with. I have a picture of every state with the days on market. The Midwest and Northeast are the shortest days. Across the South are the longest days. Like, it's a striking two-tier market happening. I've called it the Great Stay. We are staying in our houses. We're staying in town. But it's not just real estate. It's also staying in our jobs. We're not quitting our jobs. So this stay is underway. Folks like Guy Berger, the labor economists, have helped me notice those parallels between housing and the labor market. So what I'd like to start with you is your take on this big migration pattern and, what I've called the Great Stay, the North-South, however and tell me about how you look at the Great Stay, this migration pattern. Give me your view on the whole dynamic.
Sure. So it's a really interesting time because, as you know, there's a lot of parallels with what's going on with housing, with what's going on elsewhere in the economy. So I think one stat to really just point out that really puts this, you're calling it Great Stay. I haven't come up with that name before. I like that. I like that name. Is that the number of households moving to a different metro area is down 30% from 2021. So we add up all all the households that moved from one metro area to another, from all across the country, total all those up in 2021 versus the last 12 months through July of this year, which is our last available data on migration. That number is down, 30%. So big shift. It stayed roughly at the same level over the last year or so. So it really declined from 2021 through about late 2023. And it's just been a very steady, slow and steady rate since then. There's a lot we could go into, but that's, I think, just to frame up the context.
So total households moving. Basically, if we think about what drives a realtor's business, relocation is one of the big numbers, and that's down. Relocation is down 30%.
That's right.
And so that's a function of housing affordability. That's also a function of like job availability. I'm not quitting my job in Chicago, moving to Orlando and hoping to get a better gig in Orlando.
That's right. I think there's a handful of things there. There's like the demand side of the equation where companies are just hiring less than they were before. Fewer people are listing their homes for sale than maybe in 2021. But then we're also seeing that for people that do list their homes, there's a lot more so we survey real estate agents every month. And one of the things they noted to us is that delistings, you probably have data on this too, but delistings are above normal in almost all parts of the country, particularly in Florida, along the Southeast, where we saw, again, just a booming housing market 3 and 4 years ago, where it's really cooled down quite a lot in at least just the last year. So what that tells me is that there's a few reasons for that. Again, we asked them, like, if people are delisting, what are the biggest reasons why? The number one reason why is that their sellers are not getting offers at the prices that they want. So do you think the typical seller saw their home value rise and rise and rise, and it hit a high water mark probably in 22 or 2023, maybe into 2024, and they're maybe getting advice from an agent saying, hey, we could list it at this price, but your offers might come in a lot lower than that. You could probably sell a lot faster if you drop the price 10, 20%. What we're seeing is that sellers would rather stay where they are. They'd rather hold on to their home, or they'd rather delist it and try again next year. So sellers today, I think, are not meeting the market where buyers are, essentially. So that's, in addition to the mortgage rate lock-in effect, which is, well known at this point, 50% of mortgage borrowers have a rate below 4%. So that's still keeping people in their homes. But essentially there's no distress on the seller side of the equation. So they're saying, why would I take this loss? Even if it's not a paper loss, maybe they are sitting on a few $100,000 in equity gains since they purchased, but it still feels like a loss if they're selling below where it was a year ago.
Yeah. So, delistings are way up, and we call them withdrawal rate. And I like to look at the withdrawal rate as a percentage of the new listings. So like, what percentage of new listings are frustrated? Like those folks, and that always goes up over the holidays, right? It always goes up to 40% or something like that over the holidays, but it rose June, July, August, significantly more delistings right now than in normal years. And as you say, like, I think like sellers aren't getting the offer they want, and it's really painful to take a loss, even if it's just a perceived loss. So that's interesting, though. You think, is that cause or effect for the migration pattern?
I think it's a little of both, but I would look at that for someone to buy a home, let's say in another part of the country, for most people, they have to think about selling their current home. If they're moving from the Northeast, some people are going to be able to hold on to it and fund a new, home purchase with retirement savings or something else. But for most people, they're only they only want to carry one house on their balance sheet, essentially. So they're thinking about selling, right? So that again I think is how I see it as a cause mostly is that they're not able to sell at the price that they want. So they're having to take a cut. I think some of it is effect too. So yeah, there's not people in the South, for instance, might not be getting offers because people aren't moving, in the South to the same degree that they were. So there's just fewer buyers in the market today also.
Yeah. Do when you talk about, so the number of households, the relocation stat
Mhm.
is down 30% from 2021. Most of that fell in 22, like we stopped abruptly.
Mhm.
Um, so now we've got 2, 3 going into 4 years of very low relocation. Um, some of that was like pulled forward into 21. So if you were thinking in the early 20s, you're thinking about moving to Florida, 2021 came around, you're like, I'm moving. So some of that demand got pulled forward, but some of it is like now there's some accumulation of people who want to move who haven't been able to for 3 years. Do you have a sense on that relocation, like how much is built up? Have you thought about it in terms of like there's 4 million people who want to buy homes, they want to move, but haven't. Have you thought about it in those numbers?
Yeah. So I try to find, and I love thinking about this stuff, and it's always a struggle to find the best data to inform like what's going on. Well, there's a New York Fed survey of consumer expectations, and one question that they ask their panel is for homeowners, how long do you expect to stay in your current home? And they've asked this question over few years now, so we can see a little bit of a trend and a history. And you can slice it by age and demographics, other demographic factors. And one thing I noticed it's 4 years ago now, the number of homeowners under 50 that say they plan to stay in their home less than 2 years or 2 years or less jumped from like 10% up to 25%. So we can think about homeowners under 50. If we believe this New York Fed survey, then a quarter of them expected to move within 2 years, 4 years ago. So it's
Right.
been at this really high level for 4 years now. So there's at the same time that the median, tenure in homes is at a record high and has stayed really, really high. So I think again that points to that stuck dynamic where people want to move. Maybe they bought a house in 2021 that they expected, oh, I want to get in now because we won't see below 3% mortgage rates ever again. So maybe they compromised on their house. Maybe they said, we'll live in maybe not the ideal part of town or not the ideal home. Maybe it doesn't fit our needs exactly, but we just want to go in and capture this opportunity. And now that they're sitting with the possibility that they're gonna have to stay for quite a while before they sell or before they can refinance, or I think there's quite a bit of pent up demand for mobility.
And I think about that for 26. So, you know, we have relocations that haven't happened that they want to. There's some buildup of people who want to move. We have withdrawals or delistings, which are high. And these are people who want to sell but haven't gotten the offers that they want. And they don't have any distress, as you point out, so they don't have to sell. When you look at 26, what's your take on, is that pent up supply, that shadow inventory, or is that pent up demand, essentially shadow demand that's ready? So, we have home sales that are still relatively low, trying to climb off of a low of like a 4 million yearly pace. Um, it is, does this pent up relocation demand, does it turn into more home sales or does it turn into more inventory and still low demand? Like, are these people who wanted to unload and they're not? So are they buyers and sellers?
Yeah, I think it's both buyers and sellers. I think what we would see though is, well, one other thing that's going on here is that when for some of these sellers that are delisting, some of them are not just sitting on their home and waiting for 6 months, or they're not, maybe they've already moved and they're they're selling their home back, back for their used to live. Some of them are listing it actually for rent. So we're seeing landlords, sort of accidental landlords, or landlords by choice, or temporary landlords. I'm not sure what to call it. But I know a handful of people just in my friend network here that have thought about selling their home, and then looked at what their agents are recommending for prices and things like that, and they're saying, yeah, this isn't the right time to sell, so I'm gonna rent it out. We can get really good rents here. There's super low vacancy, etc. So I think we would
Costs
see
low because my mortgage is cheap.
exactly. So yeah, I mean it's a good question. I think we would see probably more homes for sale before more homes per. To the question. I'm trying to think about the dynamic there, but I think we would both see more
You think
more
it's
sales and
both sides of it.
both both sides.
The people who wouldn't be sellers and would not be also buyers would be like investors or somebody on the margins that would then sell and add to inventory, or people who own a second home or something like that they have been delaying, that is keeping inventory down. What I'm looking for, the real signal I'm looking for, is in 26, how much of this demand shakes loose, or supplies shakes loose, and how much of the pent up relocation people move. Does that tick up? And so there's a couple of questions there. Does it tick up? One question is, how do we know? Like, what are you watching for to know that, I think relocation is going to start ticking up? And what's the potential for 26? How much will shake loose? Like, are we in, is it another full year of 30% fewer moves than want to move?
Yeah. So the way I sort of think about this, a lot of it comes down to solving for that monthly mortgage payment that lets people buy the home that they want and sell the home at the price that they want. So when mortgage rates coming, they're down a little bit, but they're still in the mid to low sixes. For the resale market, I think there's a nonlinearity at 6%. So again, sort of the data that I'm looking to on this is that what do agents tell us that their sellers will they'll list the homes and their buyers will buy homes. Like, what's the rate that they need? And we see a real shift if mortgage rates go below 6%. So at 6% and below, I think we would see an unlocking of more buyers willing to step back in the market, more sellers, willing to test the market.
Okay. So 6% is your magic number.
It gets to the magic number. Yeah. I think there's it starts to look a lot different below 6% than where we are currently.
6% is roughly my magic number too. The way I've done it is looked at, there've been two moments in the last 3 years where rates got close to 6%, last September and the beginning of 23. And in both of those cases, we could see transaction volume kick up. We could see prices resilience in those cases. And so I've been assuming that 6% is the number this year. I have some thoughts about that for 26, but it's nice to confirm that you guys see that action, and you called it nonlinear at 6%. Like, the things go slow and then there's like an inflection point at 6%. So
Right.
That's an interesting take. Tell me about the cities to pay attention to. You did this big webinar recently where you had like all the big, we're talking in general, we have for many years been selling from the Rust Belt, right? Chicago, across Ohio and Michigan, Pennsylvania, then upstate New York, Connecticut. We've been like that north to the south, and we sell there and we buy in Orlando or Sarasota or Austin or Phoenix or even Denver in the Sun Belt. And as this relocation is down 30%, and and by the way, can I get do you like publish that relocation number? Like, is there a total thing like that we can like track and talk about?
Yeah. I've calculated it off to the side here. We don't have in any of our reports, but I think we can. I'm happy to send you a
That
chart.
would be great. That would
Yeah.
be great to track the relocation number. So this is that those folks. So that's down 30%. So we're not selling in Connecticut to buy in Sarasota. Inventory is tight in Connecticut. It's very high in Sarasota. So that's for everybody to know the dynamic that we're talking about. Talk to me about specific cities and what's happening individually. Which ones should we pay attention to? What's going on now and for 26?
Yeah, so I would look at, a couple that come to mind, um, on the spectrum of concerning and to a spectrum of surprisingly good. On the end of concerning, I would look at markets like probably Phoenix would be number one. Phoenix, for as far back as I can find in the data, has just been a very strong net migration market for domestic people. So a lot more people moving in every year than moving out. And what we've seen since in the last couple of years, and it's kind of reaching a tipping point currently, is that net migration is getting closer and closer to balanced, where the same number of people and households moving in as moving out. And what we're seeing actually, if we look under the hood a little bit, is more people moving out of Phoenix versus 2 years ago with the same number of people moving in, right? So we're just getting closer and closer to net zero net migration in I think some of that, again, is housing market related. But that's one market I would look at really closely in 2026. Look at the job growth numbers, look at the migration numbers, look at home sales and rental absorption.
Phoenix, that's a big change for Phoenix.
It
Two
is.
questions. One is, where do they go from Phoenix?
Where do they go from Phoenix? That's a great question. I should know this. We have the data.
Is it like northern Arizona or is it, like
Yeah, we're seeing into other parts of the Southwest essentially. So up to even Boise,
cheaper parts
cheaper,
of the Southwest?
right?
That.
And you think see in these markets where prices increased so much so fast that there's a bit of a correction happening where it doesn't have the same affordability attractiveness that it used to. It's still cheaper than California, but it's not as, the difference is less.
That's a big, big change. I've been watching from the housing data side this year, Denver. So inventory is way up in Denver. Price reductions are up in Denver. Like that's a market from the housing data side I've been. And Phoenix is always what I call like a high beta stock. It like moves up and down faster than the rest of the market. But Denver this year feels different. It feels like it may be like a net migration driven thing. Do you have a view on Denver?
Yeah, so I can look out my window and I'm in the Denver market, or I'm just outside. I'm in Boulder, so it's close to home, literally. I know there are a couple of things going on with Denver. One is that there is just a ton of supply that came on in the last couple of years in both the for sale and the rental market. When I drive down to Denver along 36, there's been new rental buildings coming out of the ground even as everything else is slowing down, there's still new buildings coming out. And then I know in downtown Denver, just along some of the submarkets, again, just a ton of new supply that's getting leased up, but it's getting leased up slowly. The other side is that job growth in Denver has slowed down pretty significantly in the last couple of years. So just the demand side is much lower. And then if we look at just a little bit outside of Denver, so there's the Denver metro area that we, is a handful of counties, and then there's the Boulder metro area. Then they're just north of Denver is Greeley, which is Weld County, which used to be a farming town. There's still a lot of agriculture, but it's a booming market right now. There's a ton of net migration, and a lot of it's coming from Denver. So what turns out is that when households are growing, or they need a bigger home for a growing family, or they just want a yard for a dog or something like that, Denver is much more attractive to move north to Greeley. And what allows that now, so it's the drive to qualify sort of phenomenon, which is not new. But what's different today is that in the front range, work from home is much stickier than other parts of the country. So work from home is still, again, very, very, very common in this part. So people are willing to commute, if it's an extra 45 minutes in the morning, you only have to do it 2 or 3 days a week. They're willing to make that trade-off for a yard with a fence or lower price housing, essentially.
Yeah. That's okay. So that says a ton there. So Denver job growth, which then leads to our great stay, which is like if I'm selling in Chicago, like I know a lot of people have done that move, Chicago to Denver move. And if there's no jobs growing, like opening in Denver, I stop. So I'm not selling in Chicago. I'm not buying in Denver. The drive to qualify, the work from home. Is it your take that, and it sounds like this is Phoenix and Denver. Is it your take that the exurban, like further out than suburbs, Denver's pretty suburban, but like further out, the exurbs are going to have better growth this year in terms of demand, pricing, et cetera?
I think definitely
26 is the exurbs year.
Yeah. I think so. I don't know if I would call it the exurbs year, but I think there's a lot of things going for it. Again, the work from home is stuck. It was a big question coming out of the pandemic. How common will this be? And we saw a ton of return to office announcements from very, very large companies. It seems like one a month or one every couple of weeks. But then also 6 weeks later, there's another story that says this company's return to office mandate isn't really working. Then have to try something else. And in the data, work from home is stuck. There's a couple of markets.
It's not going down. We're not returning to the office anymore. But
And
it's sort of there.
It's there, yeah. And there's some, one-off examples like in DC, for instance, where the government can say like you're not allowed to work from home and we're not going to let you work from home. You have to come into the office. We have seen a shift in DC, but for most parts of the country, and New York is another one where when I seen clients in New York, in a lot of the bigger cities, really, a lot of them are in the office for 4 days a week. Again, but still, I mean, that's different from 5 days a week, which is what it was 5 years ago or 6 years ago now. So I think we can confidently say that we're not seeing a shift away from work from home like a lot of people expected. So it's really stuck.
Yeah, that's the data I've seen too. That's really, I think, really compelling. It's, as much as we talk about return to office, it seems like we're at a new normal expected level. I've noticed that I think in the data, and I can look it up quick, but I think it's like smaller companies work from home more. But even those have stayed pretty stable. It is sort of like we've figured out how much is acceptable now to work from home and how much is productive and how much maybe it's even optimally productive that way in the current model.
Yeah. I was just talking with someone before this, talking about demographics as sort of a glacial science, but there's times where it moves really fast and things sort of change. There's a regime or paradigm shift, and work from home is one of those that happened during the pandemic. We are just in a different paradigm than we were, and it has a big impacts on housing and migration trends. Like the most common work from home jobs tend to be the higher income jobs too. So again, it has impact on what homes builders are what kind of designs builders are building, what homes relocating households want.
Yeah, right. So if work from home jobs are higher income, and therefore I'm happy to move to Greeley from my whatever Littleton or some suburb outside of Denver. Now that means that we're moving the bigger income to the exurbs.
Yeah, that's a good point. Yeah, these relocating households are not necessarily. When I compare this to like 05, 06, where drive to qualify because prices were so out of whack and borrowers were getting mortgages that probably weren't qualified. This is just a very different sort of drive till you qualify. It's drive till you can find a home you actually want to live in is kind of what the dynamic is, I think. And these are higher income folks.
Fascinating. Okay. We've done a lot on the Great Stay and the migration patterns, the internal migration patterns. We got a ton to cover today. So let's move on. Let's talk about immigration. That's another, maybe even a paradigm shift in the big glacial demographics. the glacier calves off into the ocean and we have a new world.
Right.
Uh, what so obviously big clampdowns on immigration, both low skilled and high skilled. It's H-1Bs. It's like everything, locking out as much immigration as possible. So is that true? Are we successful at locking out immigration? Is that happening, or am I on Twitter too much? And then what's happening to housing as a result of the changes in the immigration policy?
So I'd sort of divide up the immigration question into normal and abnormal immigration. So normal immigration, we always see, people coming in on visas, so permanent, worker visas or temporary visas. So these are international students or H-1B visas, technically, in their families. The sort of irregular, abnormal immigration that we saw through the southern border in over the last 3 years, 22 to 2024, that is effectively closed. So the border, is again effectively closed. I have a chart in our report showing, it's just December 2023, 250,000 people were apprehended at the border and then allowed to stay in the country until some future date. That number went from 250,000. It's now at 5,000 a month, and they're not being released into the country anymore. So they're being sort of turned away. So very different. We went through a very strange time in those 3 years, and we are now actually way below normal in terms of migration through the southwest border. However, so then the more legal channels, so the more regular channels, visas, et cetera, those are still happening at a fairly healthy pace, a fairly normal level.
Despite headlines to the contrary.
Yeah.
Okay.
Yeah. So, the number of immigrant visas issued still around 600,000 in the last year, last 12 months. It's higher than it was in 2019. We are seeing some decreases. So it was over 600,000 a year ago, and now it's dipping to around 600,000. Also seeing the disruptions in the international student visa program over the summer. Like interviews were paused for about 3 weeks, and that was a crucial time because that's when new students were making their decisions about where to go. And even though, the interviews were resumed in June, it turns out new international student enrollments are down somewhere around 20%.
Okay. All right. So that's down 20%. It's resumed. So presumably next year might pick back up again.
It could.
1 year. Yep.
Yeah. I mean, it hard to predict, but it would seem to me that it's that, again, that critical 3-week period really disrupted things for the freshman class.
Yeah.
Of new international students.
Okay. And but generally our high skilled, normal, legal channels are not, they're declining, but they're not low. And so in this picture with the illegal clamp way down, what's the big view on the housing impact of that? That's a lot of illegal, but those folks, illegal immigrants, are generally not buying houses, right? They're
Right.
they're renting somewhere, I'm sure, but like, what happens to the market?
So it does sort of, so the last 3 years, again, the immigration surge, we think it primarily people from that population, those that did occupy households or form households, mostly in rental units. There's some home buyers in that group, but very rare. So it takes away sort of potential new demand, but what we think was really going on there is it filled up mostly smaller apartment buildings in lower middle income submarkets of major cities. They're not, with clients that we work with that are, investing in Class A or managing institutional grade properties, not a ton of direct impact, but it did increase the overall occupancy in the market. Right. So I think for one piece here that's really fascinating, we're trying to get data on this, and we're planning to survey our rental panels in the next couple of months, is we've seen elsewhere in the economy that the Hispanic population, foreign-born population, whether they're here legally or their legal status has changed or they entered undetected at some point in the past, we think they're sort of doing what they can to avoid surveillance or detection. So that looks like they're not responding to surveys in the same way that they were a year ago. They might not be sending money back home through remittance payments to the same degree they were a year ago. So they're sort of and I don't want to say hiding, but they're missing from a lot of the stats currently. It's causing a lot of distortions in some of the government numbers there. Also going on is that if you're a Hispanic household and your legal status has changed recently and you need to move or you want to occupy a household, you're probably less willing to apply for an apartment or get a credit check or something where your name would show up on a database somewhere. So we think there's probably some retrenchment happening among existing residents in the rental market. So fewer households being formed, maybe some doubling up happening. We see it actually. So some of the consumer brands that serve this population, like Constellation Brands, for instance, talked about it on their earnings calls. They were seeing an impact on demand for their products. Fewer people are gathering in large groups, so they're buying less beer, for instance, or they're not shopping at the same supermarkets the same way they were. So we think that's impacting the rental market, trying to put numbers around the actual impact of that. On the for sale side, there is an impact of the for sale side that is kind of interesting and impactful, that the new H-1B-C, so that was announced in September 21st, I believe. So that by the letter of the regulation, it only impacts people that are coming into the country new. So it doesn't impact current residents at all or current H-1B holders. But what we've seen and what we've actually heard from our clients tell us directly is that the current H-1B holders that make up a very large share of new home sales in some markets are retrenching. So they're nervous about, hey, my visa's up for renewal next year. This new regulation doesn't apply to me, but they realize the regulation and the policy can shift virtually overnight. So they're sort of in risk-averse mode in a way.
Yeah.
Trying to go to cash, or they're listing homes or they're not buying homes.
Yep. Interesting. Oh, so they maybe go to cash, they maybe listing. I was in Dallas this week talking with some agents, and, for inbound tech population, I think it's largely Indian, a lot of H-1Bs. And of course, they tend to be high skilled, high income earners. And so, there's a legislation where it's like H-1Bs won't be able to get FHA loans, but that seems pretty marginal because they're high income, they're not getting FHA loans anyway. But what you're saying, so maybe what these folks haven't noticed yet is that the demand in those neighborhoods may be declining just out of fear for not knowing the regulations or what might happen, even though the current regulation isn't impacting them now. They're not going to have to pay a fee, but who knows what happens.
Right, exactly.
Okay. That's a fascinating track. So, I live in San Francisco, so Silicon Valley has a lot of those. Where else should we pay attention to?
I think some of the big sort of tech markets, Seattle, Austin, Raleigh-Durham. It turns out if you look at Stockton, California, so Central Valley, the number kind of shocked me. 17% of mortgage loan locks last year were from immigrants without permanent residency, which is a population that includes H-1B buyers. But that's what, 1 in 6?
Stockton, California.
Yeah.
That's interesting. So my take, I saw that data point from you. So my take on that is those are like not a lot of H-1Bs, but because it's probably more Hispanic, Mexican population, but it's like folks have been there for a long time. They've built a life. They're prosperous. It's relatively affordable. And so that's where they are buying. But they don't have permanent resident status for whatever they're on a green card or whatever I don't exactly know which things fall in there, but they may be legal.
Yeah.
And they're on some kind of visa, but it's not actually permanent resident.
Right, exactly. So permanent resident would include like a naturalized citizen. It also include the green card holders.
Green card is per. Um, so the fears of the regulation, though, are seeing things. So, yeah, we were talking in Dallas this week, and the community, the parts of the town where you get like high skilled immigrant, that would be fascinating to see if that slows down, if some of those change.
Yeah, I mean, from some of our home builder surveys, or from our home builder survey coming from a couple months ago, we asked like, what in your market, what do you think H-1B buyers represent in terms of the overall buyer base? Nationally, it's like 10% or lower. That's not super significant. It's a part, but it's not. But if you look at some of these markets in Texas, for instance, it is much higher. And we've seen data that, and these are new homes. So I think the other thing to say is that what we found is that these H-1B buyers tend to go to new home communities rather than the resale market. So they're much more sort of heavily represented in newer home communities where they're buying a
A
lot.
little bit of self-reinforcing too, community-wise. Like, this is where my people are, so I'm going there.
Exactly.
Yeah. Okay. Well, that's really fascinating. They are insights on how that I didn't like parts of the country I wasn't really thinking about there. Okay, let's shift gears and talk about age and generations and those dynamics on the demographic side of housing. So, a couple things are bubbling around there for me right now. NAR came out with their survey that said the average home buyer is now over 40. That made a bunch of headlines, especially when you think in terms of a 50-year mortgage.
Right.
But there's still other data that, shows maybe first-time home buyers are not increasing in age. Like, first-time home buyers are still whatever, 31 or something like that. Tell me what I should know about the age of people buying homes right now.
So just in general, like the population, the adult population is generally older. So you expect over time, the median home buyer is going to be older and older. It's just, we would expect that. I think the fascinating question is, what is the age of that typical first time buyer, and how has that changed over time? So we've tracked the NAR data for years now. It seemed believable, that, okay, we saw median age of the first time buyer was around 31, 32 for most of the 20th century up until 2020. And then it was just hockey stick up. So now the latest data point is that from the NAR is that the typical first time buyer is 40 years old. It's a shocking trend if that's true. We try to triangulate a bunch of different metrics to answer that question. That's one way to answer it. But there's at least a half dozen other ways to measure this phenomenon. And I was just pulling this data together yesterday, so it's really fresh. And I'm actually looking at a chart on my screen where I'm plotting 5 different estimates over time of what that typical first-time buyer age is.
Awesome. You heard it here first, folks. Here's the data.
And what it shows is that NAR estimate of 40 years old is higher, significantly higher than any other group's estimate. The range of the 5 others would be 32 to 36. So that's
a little bit higher, a little bit older than in the whatever 90s or 20 years ago. 32 to 36. And what sources are we looking at there? We're looking at like mortgages, that kind of.
Yes, a handful. There's a couple of surveys, so we can look at it in the census current population survey, annual social and economic supplement, or the and then there's a Census American Housing Survey. We can sort of, again, tease the data a little bit to answer that question. The New York Fed has their own estimate based on a sample of credit reports. So they're taking a 5% sample of credit reports and finding, again, what's the pattern of when someone goes from having no mortgage on their credit report to having a mortgage. They can kind of like estimate who are the first-time buyers and how old are they. And the other one is that the FHFA did an analysis a few years ago using the National Mortgage Database. So there's surveys, there's administrative records, there's actual like based on behavior and then survey. So again, the NER is higher than all the other estimates, 40 versus 32 to 36. The other estimates too show that the trend is either flat or just slightly up. So the NAR trend is much steeper than any other sources. And there's a couple of reasons that I'm not just looking at the stats, like looking at its anomaly from all the other measures, but there's a couple of other reasons that I'm like, is this still a good metric to look at? Is it still reliable? So, my colleague Rick Palacios, who has a story about this, but essentially the survey is 137 questions, and it's mailed out to a lot of
our survey. The
the
NAR survey.
is the NAR
Yeah.
survey. You got to think, like, who is taking the time to fill out 137 questions on paper, sending it back in the mail. It's a very there's a sample of
like my daughter in her 20s. I'm pretty sure she doesn't ever pick up her mail. Like she does. Like her
right.
So okay. So the NAR number may be a function of surveys getting worse, but overall, so one of the reasons that gets headlines, though, it gets headlines because it speaks to affordability. It speaks like, no, young people can't afford homes. It gets headlines because I talked about that. No, I saw that number. It's like it triggers a thought about, it's like confirms our biases about affordability in this country. Right. So based on what you know about the age of people buying homes, what picture does it paint for you about affordability and, this country's going to hell, or, what picture does it paint for you based on what you know about the demographics of home buyers?
So what it tells me is that, so my sort of takeaway from all of this median first-time home buyer estimates is that the first-time home buyer is probably older than they used to be, than 5 and 10 years ago. But this increase from 31 to 40 over the last 6 years, probably exaggerated.
Yep.
But that's not to say that there aren't significant barriers to first-time home ownership for people in the country today. So just a couple of, again, kind of shocking numbers when I put them all together, is that if you take someone that's renting a single-family home somewhere in the suburbs, in any town USA, the average or the median submarket of the average median to metro area, they were to buy that same equivalent home across the street, buy a single family starter home with today's mortgage rates, with today's home prices, with a 10% down payment, their monthly housing payment would go up 38% overnight, just to own that home versus rent it. It includes the mortgage payment, includes insurance, taxes, and maintenance as well. You take someone that's living in an apartment, and again, in that same metro area, the same submarket, and they buy a single-family starter home, their monthly housing payment is going to go up 93%. So again, those numbers are way out of whack or way off what they typically are. So affordability, if we're just looking at substitution, I don't want to talk about any comments. If you're just looking at this housing payment, right? It's so like the cost of ownership are so much higher than rents and so much higher than they typically are. That renter that's thinking about, okay, my lease is coming due. Do I want to stay where I am? Do I want to find a better deal across town? Do I want to find a better unit? Or do I want to, is this the year to buy? There's that urgency to move into their first home that's just gone currently, or it's much less than it used to be.
Yeah. Yes. Okay. So it is dramatically more expensive, and that is both the cost of money and the cost of the asset itself. Right. Do you have a vision for when we move out of this cycle? And it's also the cost of the rental is low. So
right.
They're both at their extremes.
Right.
So do you have a vision about when we move out of this cycle?
It's hard to see if and when a real like inflection point happens, but there's a couple of things. It's hard to see a situation where outside of markets where there's a ton of supply, like in Austin or markets of Florida, where home prices declined significantly. The replacement cost, in terms of like replacement cost, the cost to build a home just from the materials alone is 40% higher than they were before the pandemic. So that's, I think like builders aren't going to build homes that they aren't profiting on. So they've had to increase their prices. So I guess what I mean to say there is there's a floor there on home prices, I think. Where this could shift is in a couple of years, if we do see a lot less rental supply come in, which we think is happening, if the economy is still running, if we don't hit a major recession, if mortgage rates don't balloon back to 7.5% to 8%, we could see rents start to catch up with the cost of ownership. Probably not to where they used to be, but closer, right? So again, that choice of a renter that's saying, do I want to pay 10% more in rent next year, or would I pay 25% more to own? It might look a little bit, might be a little more attractive. So
Yeah,
I think it's a couple of years. It's a gradual process. I think it's going to take a couple of years. It's hard to see it shift or unlock overnight unless something happens with mortgage rates dropping significantly.
Yeah. So then let's shift then through further out in the future, like the 2030s, the next decade's home buyer. Who buys homes? Are we having enough kids? Like, those kind of things. Are you a pro-natalist? You know, what, what should we think about the future demographic arc, and what that means?
Yeah, I mean, I think the reality is that we're having fewer babies today than we typically do, or we have in the past. Actually, we're probably going to end 2025 with the same number of babies born as in 1983, even though our population has grown by about 110 million. So a real significant shift has happened in birth rates. We see far fewer younger parents. First-time parents are older and older. So this family formation is happening later, which points to why might the first-time homebuyer be older and older. Families are forming later, right? The birth question is a really deep question. I try not to have I have my own biases. I just need to own that, right? I have my own biases on it, but just from a more of a zoomed out, try to be objective. It's hard to argue against that. This is a very different environment today than we ever been in. And if we look out, 10 years in the future, if mortality or deaths increase like we expect them to, unless something dramatic changes with life expectancies and the healthcare system and old age deaths, we'll see more and more people pass away. And unless we see a lot more people being born, at some point we'll hit a point where there's more deaths every year than births. And I think that happened once in our country back in like 1918 during the Spanish flu epidemic from 100 years ago. So this is not, again, unique to the US. This is a pattern that's going on in most parts of the world. So again, we're looking at a future that is very, very different from the past. I don't want to have a value judgment on it. Is that bad or good? But it is different, right? And there's a lot of things that can change alongside that. Like if productivity still keeps growing at a certain percent a year, if life expectancies increase over time, if retirements get longer and more active, it's again a very different situation. So I'd say in 10 years, we're looking at home buyers with probably smaller families. We're looking at home buyers that are probably older in general. We could also see an increase in people selling homes, like old folks either passing away and their kids selling their home because they don't want to be a landlord or they don't want to divide it up among 3 or 4 siblings. But also when people hit between 75 and 80, generally they hit sort of the last big housing transition. They either decide to say, I'm staying where I am, I'm hunkering down, I'm aging in place, or they decide to move into a rental or to a multi-generational living situation. They move in with one of their kids, or they move into sort of a group setting, into assisted living, et cetera, skilled nursing. So I think we will see more sellers, probably in different parts of the country, the Midwest and the Northeast, where the populations skew older. Yeah, next 10 years is going to be exciting for housing and demographics. A lot of shit's going on.
Yeah, so more sellers back to the Midwest and Northeast where they are not selling now.
Right.
So that is, and in the next decade, boomers get to the age where they're finally dying. In housing, it's been called the silver tsunami for probably 15 years. Expectation of, all these boomers selling the homes. Is that coming? Is it a downward pressure on home prices, big inventory in the next decade or even closer?
Well, I think this tsunami is probably, again, exaggerated. I would call it like a gradual. I don't know,
It's like high tide. It's like high tide rather than a tsunami.
Yeah. There's so again, when you think about what happens to people's homes when they pass away, sometimes they get sold. Sometimes they're, passed on to a family member. Sometimes the family member rents it out. We think the number of homes that are listed for sale due to old age deaths will increase over time, but not to a shocking degree. We think the number is probably between 700,000 and 800,000 per year, 700 to 800,000 per year, which is just a little bit higher than it is today.
Okay.
I think, but the other side is it's not just people passing away; it's also people moving into rentals, moving in with their kids, etc. So it's going to be more and more important over time as the population ages. But there's a big wave of people that are entering their homeownership years. One stat I shared on stage last week at our client conference: 13,000 people a day, at least, for the next 10 years will hit age 35. So we think the middle part of the 30s is really that meaty part of people buying their first home. 13,000 a day, every day for the next 10 years.
Right. For the next 10 years. So that's the millennial. That's
Millennial and the Gen Z. Well, it'll be the Gen Zs in next
right.
years from now.
Next 10.
Which is a huge generation, by the way. They're just massive.
Yeah. And then it's so then it's the replacement behind them after 10 years that now is when the babies we're not having now start getting into the mode. And then we have to, hope that's solved by robots. Or until we go, our productivity, AI and robots picks up for the things that the kids mowing the lawn today, but in the future it's my robot lawnmower.
Yeah.
Okay. We've been going, I could keep going for a long time. I'd love a quick take on 26 from you. Things about, household formation or any of the things that you're looking at in 26 that form your view of, do sales increases, do prices, are they heading down, lower, whatever you got for 26?
I think just the overall demographic demand we look at slightly below normal in 2026 because immigration is so much lower than it was in any normal period. So that's one piece that translates to less job growth, but also there's the economic cycle. It's kind of, I think it remains to be seen if all the slowdown in job growth is immigration related or how much of that is from an actual decline in demand for labor. But if we were to see job losses like we saw in June this year, like we had a month-over-month decrease in employment for the first time outside a recession since 2010, if we see a softening in job growth, that's just net negative for real estate, for housing. So I would look at, again, job growth.
And that's it. The numbers have been softening. We haven't had, we're kind of dark on things right now, but it's a risk. Job losses are a risk for 26.
Yeah.
Yeah. Okay. Any other data we should be paying attention to? I love the what we started our conversation with, the total number of um, relocations down 30%. Each year's 30% lower than normal. The 13,000 a day, people turning 35 for the next decade. Those are home buyers, 35-year-old home buyers. There's some good data here. Anything else that is a fun one that you're paying attention to?
Well, I think the question on what home builders expect for the year, what they plan on doing for the year. So this is what home builders do. It impacts the resale market. It's adding supply, right? So
Yep.
I think we're surveying our home builders this month on what they plan for next year in terms of how many more starts they plan per community. That's just been a fascinating stat to track. Yeah, that would be one that I'm watching very closely.
Say it again. What's the stat?
It's what home builders expect to build next year. Do they expect to increase the number of starts? Do they expect to decrease the number of starts? Are there any regional differences? They expect to increase in the Northeast and Midwest or decline in Florida and Texas. I think it's just so I think so much of what's going on right now in housing is supply driven. And that is, again, a really, I think, unique way to look at future
The home
supply.
builder expectations for 2026
Yeah.
is really great. And you have a sense regionally, like, we've been building in Texas and Florida and Denver and Phoenix. Are those slow? Are they clamping down there?
Yeah, it slowed down a lot even during after the spring selling season. Like Florida builders expected to increase their output or their starts by like 14% in 2025. When we checked in on them again mid-year, they said, no, we're actually going to keep our starts the same level as last year, which again, it causes layoffs, land sales slow down. It's also a reason why I think the immigration crackdowns haven't had a big impact on labor supply because just fewer workers needed. Builders actually laying off workers or had over the summer. And yeah, less impact in the Northeast and Midwest. Home builders are still trying to build there.
Which is where we need houses right now because we're not selling there. Okay, Eric Finnigan, VP of Demographics, John Burns Real Estate Consulting. Thank you so much for the time today. Super insightful. I got a ton of stuff. I've got like 10 pages of notes that we've been tons of great takeaways. Where do people follow you? You publish on Twitter and LinkedIn, and where should they find you?
Yeah, so I think you can follow me on definitely on Twitter. First last name is my handle. I would also suggest I'm one of like 100 plus super. I'd say my colleagues are super smart. We publish newsletters and insights to our newsletter list at least weekly. So you go to our company website, jbrec.com, sign up for the newsletter there. It's a great way to get general housing insights.
Yeah.
Or follow me on LinkedIn, shoot me a message, say what's up.
Great. Thank you so much.
Thanks, Mike.
Yeah.
The Real Estate Conversations podcast is brought to you by Compass Academy, the go-to source for real estate agent education and on-demand learning. All Compass agents have access to Compass Academy's extensive library of content, video, and technology for building a high-performance real estate business. Compass Academy is also one of the reasons that Compass agents are the most productive in the industry. Learn more at the Compass Academy link in the episode's show notes.